This is The Corner Series, a McGuire Woods series exploring business and legal issues prevalent in today's private equity industry. Tune in with McGuire Woods partner Jeff Cockrell as he and specialists share real-world insight to help enhance your knowledge.
Thank you for joining another episode of The Corner Series. I'm your host, Jeff Cockrell, a partner at McGuire Woods. Here at The Corner Series, we try to bring together deal makers and thought leaders at the corner of healthcare and private equity. Today, I'm joined by Patrick Keavy, a managing director at Bailey & Company, a middle market investment bank who I've had a long relationship with over the years. And we're going to delve into some nuances of some sub-segments within the payer services arena. But Patrick, if you could introduce yourself and maybe say a little bit about Bailey & Company.
Yeah, thanks, Jeff. Appreciate you having me on here. Bailey is a middle market healthcare only investment bank. We're about 50 employees right now, 40 bankers, 12 managing directors. We cover all areas of healthcare services with a provider orientation, healthcare IT, and then payer services, which is where I spend all of my time. We have become one of the most active banks from a healthcare perspective in the middle market. Closed 13 or 14 deals so far this year. We'll probably end the year with 25 plus across all segments of healthcare. And we're entirely focused on the middle market. So the kind of enterprise values from 50 million at the low end to $500 million plus at the high end. I think our average deal size is somewhere in the 150 plus or minus range, so kind of firmly in the middle market. Probably 50% of our deals are private companies, founder, owner, operator, receiving institutional capital for the first time. And then the other half or so are PE-backed exits. So that's a little bit about Bailey & Co. My background, I've been in banking for about 14 years. During that time, focused on healthcare and insurance services. Started my career in the insurance industry. So I actually have a background in that. I spent the first 6 or so years of my career underwriting employee benefits. And then I was a consultant or broker for a couple of years in a precursor of what became Hub International. So the last 14 years focused on middle market healthcare investment banking. And now I spend all of my time within healthcare on payer services. And within payer services, there's a couple specific verticals where I spend all my time: employer health, which will be the topic of the conversation today. We'll do a deep dive on that. Insurance distribution, so think Medicare Advantage, ACA brokerage, lead generation, or services into that intermediary market. And then outsourced health plan solutions, so any kind of service or technology that can be outsourced from a health plan to a third party, cover that space as well. And just given dynamics that you've probably covered on other podcasts related to healthcare, payer services has become one of the most active areas of healthcare, as we've seen a lot of investors de-emphasize provider, maybe de-weighting that because they're pretty heavy on that over the last decade or so, and really focusing on B2B payer services. So it's become a very active area of the market. And given long-term fiscal and demographic trends, it's an area that we expect to be very active in for years and years to come. So it's an exciting place to be, and happy to be joining this podcast and taking a deeper dive on employer health.
Before we get directly into employer health, how big is the payer services market? For a long time, I feel like all the winds were pushing direct provider services in the kind of the massive consolidation of those massive businesses. And then there was a ton of interest in pharma services, which is another kind of vast array of only somewhat connected businesses. How big is the payer services market in comparison to some of the others?
Yeah, it's an enormous marketplace. It depends on how you define the actual like TAM or SAM of the payer services marketplace. But I think at the couple $100 billion at the very least, it's such a huge component of healthcare. I think healthcare is something like $5 or $6 trillion of GDP right now. I mean, payer is at least several $100 billion of that, given how large it has become. And then even these sub verticals within that can be in the tens of billions or multi-billion dollars. So it's an enormous industry. it's probably growing at a rate of between 10 and 15%. So making up a disproportionate share of healthcare as the years go on here. So very large, very fragmented within certain verticals, and consistently a fairly rapidly growing segment of the healthcare marketplace.
And you kind of break the broader payer services sector down into the three verticals that you described of employer health, health insurance distribution, so including things like Medicare Advantage and other similar things, and then outsourced health plan solutions. How would you kind of compare the relative size of those verticals, just for purposes of assessing how deep the market and activity is in the different subsectors?
Yeah, so employer health is comparable to Medicare Advantage, and we'll go through a couple of numbers here. So, employer health is a marketplace that covers about 150 million Americans. So, around 100 million people are employed and receive insurance through their employer. By extension, another 50 million dependents, like spouses, children, receive their healthcare coverage through an employer as a member. So, that's about 150 million people in total. It's about $1.2 trillion in annual spend. So very substantial. And the overall like growth rate of that is somewhere in the 10% plus range. We'll talk about like why inflation has been so strong in that segment over the last couple of years and why it will continue to be. It's one of the reasons why it's a great spot to play in, but that's an enormous marketplace. Medicare Advantage covers a smaller amount of members, but has a comparable spend. I think something like 65 or 67 million people are eligible for Medicare right now, between those 65 and older or those on long term disability. That number is growing by around 5% every year as our population continues to age. The overall spend within Medicare is something along the range of, I think it's about $900 billion right now. That's split pretty evenly between Medicare Advantage, which is the private provision of Medicare, where CMS, the Center for Medicare and Medicaid Services, is paying the insurance carriers like a United or a Humana a capitated rate to be responsible for the insurance of an individual. Medicare Advantage is about half of Medicare. The other half is just traditional Medicare. But Medicare Advantage is growing at a disproportionately faster rate as more and more people choose Medicare Advantage. And beyond the scope of this conversation, maybe a different podcast, Jeff, Medicare Advantage will continue to grow and make up a disproportionate share. ACA is something like 20 million members right now, maybe a couple $100 billion of spend. So that covers that kind of that aspect of the market. And then finally, outsourced health plan solutions. It really depends on how you define that. But I'd say broadly, it's probably in that kind of like $100 billion or so overall, like TAM. So even though that's comparatively smaller outsourced solutions to health plans, it's still an enormous marketplace and one that is growing at a probably like a double digit rate as well. So you can see why all three of these segments are very well sought after areas of investment within private equity and strategics. And again, just kind of given like long term fiscal and demographic trends here, which could be a like much longer conversation, it's going to remain that way for years and years to come.
So let's zero in on employer health. From the perspective of employer health, I see lots of kind of deals and investment theses that are surrounding kind of employer self insurance. But I am assuming that your definition of employer health is kind of more broad in the sense of businesses that are assisting actual payers with kind of cost containment. How would you segment or subsegment employer health?
Yeah, the way that we think about employer health is anything that touches an employer sponsored healthcare plan. Now, typically that means a self funded plan, but we also see a lot of services that are into the fully insured marketplace as well, and sometimes into both segments there. It tends to be more on the self funding side just because the employers have skin in the game. Have more skin in the game and have more control over the overall like, costs and can have more of an impact on that. But again, we see a lot of cost containment solutions, a lot of broader employer health solutions focused on the fully insured marketplace as well. And then, within that, there's a whole host of different verticals that focus on employer health. You have everything, and I think we'll talk a little bit more in detail on this. You have hard dollar cost containment, so actually like reducing the cost of a incurred claim. You have more population health focused services such as care management, care navigation, member steerage, and then there you have a host of services and technology that just help support these plans and allow like cost containment to take place. It may not have like a direct hard dollar ROI, but is allowing an employer to participate in a self-funded arrangement and therefore is a very valuable service because it allows this full kind of like operation to take place here.
One of the evolutions that has made kind of employer health and especially kind of self-funded programs expand has been the lowering of the number of employees that you need to have to kind of effectively enter that idea. How has that evolution changed the market and kind of what services do those sorts of companies need?
Yeah, and maybe I'll kind of take a step back here. Maybe I'll just spend a minute on what's driving this because I think it'll be a good foundational background in these various like services, like why the small and mid-sized employers are increasingly embracing self-funding, kind of where things go from here. So if you think about commercial health insurance, and may use those terms interchangeably, commercial health, group health insurance, employer-sponsored healthcare, those all kind of mean like the same thing here. Commercial insurance or employer sponsored insurance has grown at a much more rapid rate than Medicare, Medicaid, ACA, particularly Medicare and Medicaid. The reason for that is because Medicare and Medicaid, the government sets the reimbursement rate. It's by fiat. It's kind of like this is the rate. You're going to take it no matter what. Commercial insurance has always been negotiated between payers and providers. And up until recent years, there's been a high degree of opaqueness or opacity, just a lack of transparency into what actual reimbursement is across like payers. There's really been like no quality metrics like tied to like the overall like cost of reimbursement. And because providers have had to just take Medicare or Medicaid rate and have not been able to negotiate that, they have looked to commercial insurance to effectively cross subsidize Medicare and Medicaid. And because the overall industry has been so opaque, there has been no transparency to employers or to members of like what actually like reimbursement is. You don't kind of know what you're going to pay until you receive the bill in the mail. They've been able, the providers have been able to negotiate, rates that are two times, three times, five times Medicare. So a huge disparity in like pricing overall. Now, in the last like couple of years, the annual cost increase for employer-sponsored healthcare has kind of been in this consistent 10% plus range. So if you think about the overall cost or the overall like wage increases, maybe a nominal rate of like 3 to 5%, you can quickly see how a 10% increase in the cost of like healthcare compared to a like 3 or 4% increase in overall like wage increases, that's a totally unsustainable situation. And then if you look in the hard dollar amounts, the average cost of a PPO plan for like a family of four, something like $25,000. The average cost to cover a single employee is something like $8 or $9,000. You're talking like real dollars here. A huge portion of the overall compensation for an employee. And if you have a sustained 10% rate increase every year, that's going to continue to chew up a disproportionate share of overall income. So I give you that backdrop in like why this is becoming such an issue and why even these small employers, 50 lives, 75 lives, who have traditionally always sought a fully insured product because it's much more simple and the responsibility of paying claims is entirely on the payer. The costs are very predictable. You just pay your premium. Why even those smaller companies are aggressively seeking self-funded alternatives now, as opposed to just kind of a traditional, like fully insured product. So that's a big driver of the overall market growth here. I'll take a pause there, and then I'll get to your question on why they're or kind of what modalities of cost containment they are choosing right now, and what's allowing them to actually like effectively and sustainably choose a self-funded alternative.
What's the delta in what a company can save versus just kind of traditional employer sponsored health plans if they go the route of self insurance and cost containment? How much savings is actually in play?
Yeah, so it's the answer is, of course, it depends on like how aggressive of a cost containment approach you would take. So if you just go plain vanilla and you stay within a PPO plan, you're not making any changes, you're just basically moving from like a fully insured plan to a self-funded plan. You get on an appropriate level of stop loss insurance to protect if you're a small employer, protect against like a large claim, hitting your insurance and just kind of blowing up your plan. So let's say it's about as plain vanilla as you can get. On average, you can expect probably a 5 to 10% decrease and maybe a few hundred basis points off of the overall trend. So maybe like on average, right? Because there's more like variability and volatility within a self-funded plan. But on average, over like a 5-year time period, you're probably taking like 5 to 10% off the cost of the plan. Some of that is insurance profits, some of that is premium taxes, some of that is just kind of more traditional, like cost containment and care management that comes with a plain vanilla plan. And then you may reduce the trend from, say, 10% down to 8%. So you can see, Jeff, that an initial like 5 or 10% reduction, reducing trend by like 200 basis points over a 5-year period, and that's meaningful. And that's kind of plain vanilla. Now, you can take much more aggressive strategies. We'll talk about some of those. We can talk about some of those here. Say, for example, reference based pricing or some kind of flavor of reference based pricing where you are decoupling from a traditional network, a traditional like kind of PPO network. And the administrator, the claims administrator, is paying claims based off a percentage of Medicare. So say like for a traditional like PPO plan, the negotiated rate, and there's a high degree of variability in that, but say the negotiated rate is something like 3 to 4 times Medicare. Well, you choose an RBP strategy where you effectively do not have a network and claims are based by like paid based on referencing Medicare, maybe at 150%, maybe at 175%. And that can reduce the cost of the plan by 20 to 30% out of the gate. So, very, very meaningful in doing that. But the cost of that, because everything in life is a trade off and everything in employer sponsored healthcare is a trade off, is you tend to have higher member abrasion if it's not done the right way. So every bill by definition is out of network. And oftentimes providers will say, well, this is not a negotiated rate. My out of network rate is materially higher than what I'm being like reimbursed right now. I'm going to go after the member who received the care and provide that person with a balanced bill. And then the RBP provider has to go fight that. That's how we think about member abrasion. And it just all comes down to like how much of that you can accept relative to like the cost decreases you get again, because everything's a trade off there. So that's a very aggressive form of cost containment and can save, 20 or 30%. And you can see how for $25,000 for a family of four and a PPO plan, if you can knock 20 or 30% off of that, it's $5,000, $7,000. That is very, very meaningful. And you may accept a certain amount of abrasion to go forward with that approach.
So I can see the benefits to the employers and that there might be degrees of how aggressive you might be on the cost savings side. From an investor perspective, what are the different flavors of types of companies that you can invest in this arena?
Yeah. And Jeff, perhaps we can link to this in the podcast notes here. But one of the things that we do at Bailey is we publish fairly detailed research within the verticals and sub verticals that we cover. I recently worked with Rebecca Springer, our director of research at Bailey and Co., to produce a fairly detailed report on cost containment within employer health. So relevant and timely for this conversation here today. And we had around 30 interviews with different executives in the space across a whole host of cost containment strategies, but also to executives that allow cost containment. Maybe they're not doing it outright themselves, but allow cost containment to take place within employer sponsored healthcare. And we bucketed this into maybe kind of 6 or 7 different categories within cost containment, all focused on like hard dollar ROI. So I'll take you through a few of them here. One, as we were just talking about, reference-based pricing and repricing, the two of those kind of go like hand in hand. So typically, reference-based pricing just, I think, historically has been focused on just a percentage of Medicare. I think what's interesting, Jeff, is that what we have seen is that it's gotten increasingly more specific, where it's probably less RBP in the sense that it just references Medicare and then goes and fights the provider and accepts abrasion. And it is more kind of like a high powered network where, because of the transparency legislation that's passed in the last couple of years, there's much more information based on like what actual reimbursement is and what like providers are accepting. We've seen these RBP or repricing providers out there reference a rate that providers have accepted in the past and know that they will accept, maybe a little grudgingly, but will accept nonetheless, with no member abrasion. So it's kind of like morphing away from just kind of traditional RVP into like a much more specific technology or algorithm driven pricing strategy. I think that's very interesting. That can move the needle a lot. You can have various like flavors of RVP. Say, for example, like you can do a primary care network where it's in network, and then everything else is out of network and like aggressively like repriced. Seen a lot of folks do that, have a lot of success. Or you can do it entirely, the entire plan is carved out and everything is effectively out of network and everything is aggressively repriced. So there are many different companies out there providing that type of strategy and solution. And we've seen a significant amount of private equity investment within the space. It's been very high growing, tends to be like very high margins, very successful investments, very successful exits. That's a very active area of this ecosystem.
So, Patrick, in a lot of areas of investment, things kind of open up with a lot of innovation, a lot of smallish companies solving a whole array of problems. And then over time, that kind of sector will consolidate and they'll grow, and you'll get private equity investment. And then you end up with bigger players. What inning is this process in for employer health?
Yeah, I would say we're kind of in the third or fourth inning right now. It's not early stages, but there's a long way to go here. It is an industry that I think started off more as a focus on point solutions. I think it's also a much more niche industry where only a few folks, much more focused on like insurance specialization, were investing within this space. In the last few years, just given successful investments, very successful exits, continued growth in this industry, cost pressure on employers, it really has kind of blown up in a positive way. And, you have like very aggressive investments from not just the insurance specialist private equity firms, but also a whole host of like healthcare focused private equity has aggressively pursued this industry, and then just more kind of like general business services focused private equity has also pursued this too. So heavy degree of investment. We are at kind of like the mid innings as far as like consolidation goes. So still a lot of interesting point solutions that are growing very rapidly. But you are seeing, I don't know, something maybe like a dozen or so platforms within the space that become like fairly large, scaled, diversified, have rolled up a whole bunch of point solutions underneath their umbrella, and that's become very accretive given that, these point solutions have a common distribution network, typically like brokers and or the TPAs, the third party administrators, to which they are distributing their product and ultimately accessing the employer, which is the end client, the end consumer of these services. So we've seen, a pretty healthy degree of like consolidation, leveraging like that distribution and being able to like consolidate a bunch of disparate point solutions within one umbrella. That's been a very successful like strategy over the last like, couple of years here.
So, Patrick, kind of looking forward as this kind of sector, which was a little bit backwaterish, has now gotten more mainline. What can we expect in the next finishing up 2025 and into 2026 by way of kind of market activity and participants?
Yeah, so I think for the remainder of 2025, there are a couple deals in market right now. You will see those come to close. I think they'll be very successful deals in market too. And then I think in 2026, you will see an actual acceleration of deals coming to market. It's been active, probably not as active as some folks would have liked it to be, but I think you'll see probably an acceleration of platforms coming out to market in 26. And then from there on out, I think you will see like a very like healthy degree of overall M&A activity. I mean, there's dozens and dozens of private equity backed platforms within the space. Maybe there's 100 in total at this point. But also too, there's a multiple of that on the privately held side, both scaled but also interesting point solutions that'll either make their own platforms or acquisition targets for these larger scale players. So I would expect a continued amount of very like healthy M&A into 26 and beyond. This will be an area for years to come that's going to be a very active side of healthcare. And I don't see any disruptions in the economy or any other kind of like existential factors really disrupting that in any meaningful way. I think it's relatively immune from that.
Patrick, we've only scratched the surface on this kind of exciting subsector, but I think we'll have to end it there. Thanks a ton for joining me. This has been a lot of fun.
Well, thanks, Jeff. Appreciate you hosting me and looking forward to continue the conversation.
Thank you for joining us on this installment of the Corner Series. To learn more about today's discussion, please email host Jeff Cockrell at gcockrell@mcguirewoods.com. We look forward to hearing from you. This series was recorded and is being made available by McGuire Woods for informational purposes only. By accessing this series, you acknowledge that McGuire Woods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this installment. The views, information, or opinions expressed are solely those of the individuals involved and do not necessarily reflect those of McGuire Woods. This series should not be used as a substitute for competent legal advice from a licensed professional attorney in your state and should not be construed as an offer to make or consider any investment or course of action.